Welcome to the last series in the analysis of the banking sector. In this video, we'll be taking a look at the top US banks in descending market capitalization, and finally compare the banks of different countries as well as the approach you can take to maximize your investment returns. To analyze these banks, I'll be using the value investing strategy that I have shared previously in the channel, with some tweaks to step 6, and I'll also be taking into account the dividend yield of these banks. If you have not watched my analysis on the Chinese and Singapore banks, do go through them. In those videos, we are going to learn about the websites that you can use to get the necessary data to do your own research. The first bank that we'll be analyzing today will be JP Morgan, the biggest bank in US in terms of market cap. And to start things off, we always want to look at the profitability of the company. For that, we would like to focus on the net interest income, which is revenue, net income, and also the cash flow from operating activities. For these three figures, over the past 5 years, what we want to see is a consistently increasing upwards trend. We see this trend for the net income, but not for the cash flow from operating activities. So I'll give it a score of 2 out of 3 for these criteria. Next, we want to focus on the growth rate of the company. Ideally, we want to invest in companies with a high growth rate that is more than 10%. And for JP Morgan, it seems like the growth rate given by Finviz and by Zacks were rather low at a negative 1.37% and 5% respectively. But nonetheless, these two websites correspond rather well on the lower end of the spectrum. And on the other hand, if we look at Simply Wall Street, they have an extremely high growth rate of 26.1%. Alright, so just take it with a pinch of salt. And for me personally, I'll be leaning towards the growth rate provided by Finviz and Zacks themselves. So the growth rate criteria for JP Morgan is a fail. Next, for competitive advantage, net profit margin of the company itself is greater than the industry average. So that is a good pass. High ROE is slightly lacking, less than 15%. And for reasonable debt, we'll be using debt to equity. The ideal case will be having a debt to equity ratio of less than 1. And for JPM, it is currently having a debt to equity ratio of 9.30. And so far, across all the banks that we have analyzed, it seems like banks generally do have a very high debt to equity ratio. And we'll be talking about this in the later part of the video. So reasonable debt wise, I would still give it a fail. Next, let's look at valuation. To value banks, we'll be using the price to book ratio. Anything from 1 to 1.25, I'll take it as fair value. And more than that will be overvalued, and less than 1 will be undervalued. Alright, so 1.32, you can say that it is slightly tipping into overvalued territory. Alright, and for our last criteria, JPM is having a dividend yield of 3.58% with a payout of 3.6 USD every year. For me, anything less than 5%, I'll consider the yield to be low and not attractive for me. But nonetheless, we see that its payout ratio for its dividends have been relatively consistent throughout the years, and also at a rather comfortable level of about 30%, only having spiked up in the current year. And this is all due to the current situation going on and also the 0% interest rate environment. Right, so with that, let us take a look at the stock chart of JPM. Over here is the daily chart for the past 1.5 years or so, and you can see that there is nothing much exciting going on. After the March crash, it is still in the midst of recovering, and it is still lagging behind the general S&P 500. But nonetheless, during this recovery, price action has been respecting this trendline support rather well for the past 4 to 5 months, every time touching it and then bouncing off quickly afterwards. And like I've said in the previous videos, when we invest in banks, it is more for the long term. So it is more meaningful for us to look at the long-term historical chart. And here we have the monthly chart of JPM. Overall, this is the trend that I've seen. It was in a downtrend for 5 years, from 1985 to 1990, and then in a very strong bull market for the next 10 years, right? And followed by a huge consolidation for the next 10 years, and then another strong bull market for the recent past 10 years. So will it be going into a horizontal sideways market again from now on for the next 10 years? Just some food for thought, right? Let me know what you think in the comments below. We move on to the second largest US bank, and that is none other than Bank of America. For our first criteria, net interest income and net income has been performing very well, increasing consistently for the past 5 years. And a note from the cash from operating activities. Growth rate less than 10%, likewise is low. Competitive advantage is a pass. ROE is even lower than JP Morgan itself. And for reasonable debt, it has a slightly lower debt to equity ratio, but nonetheless, it is still extremely high. So I'll not give it a pass. Valuation wise, Bank of America can be considered as fair value or in fact slightly undervalued. Dividend yield is even lower at 2.77%. And if we look at payout ratio, it is even lower than that of JP Morgan, hovering around only about 15 to 20% yearly. And likewise, also spike up in the current year. What about its chart? This is the monthly chart for Bank of America. We have the pre-global financial crisis high over here at about 50, 55 over dollars. And right now, Bank of America still have not recovered back to that high yet. Right, currently Bank of America is trading at only 25.71. So if we were to compare Bank of America to JP Morgan, although their fundamental strength were comparable, in terms of price action wise, Bank of America can be seen as the weaker one. While JP Morgan has already registered an all-time high post-global financial crisis, Bank of America is still recovering from it. So just something to take note of. Although to me, Bank of America still presents itself as an attractive investment candidate. Next, our third bank will be none other than Citigroup. For Citigroup, things are starting to fall off. You see that the net interest income has been flat for the past 5 years. So that's a no. Net income, even worse, it is not only flat but irregular with a sudden dip in 2017. So that is unacceptable as well. And needless to say, for the cash from operating activities, that is a fail. And for positive growth rate, it also falls onto the lower side. And for competitive advantage, while JP Morgan and Bank of America has been surpassing the industry average in terms of net profit margin, for Citigroup, we see that it is falling below the industry average. So from this, it doesn't give me much confidence that Citigroup is able to stand out against its peers, and that will be a fail. ROE likewise is also low with only 7.2%, and reasonable debt is as usual. Debt to equity ratio is as usual, as high as the other banks that we have seen. So Citigroup has failed all of our fundamental criteria. And if we look at its valuation, it is currently very undervalued with a price to book ratio of only 0.63. And I guess you should understand the reason why. That is because of its poor fundamentals. Therefore, do you see the importance of understanding the fundamental strengths of a company before looking at its valuation? If you have not done the fundamental analysis on Citigroup and just jump straight away into its valuation, you'll be very happy that Citigroup is currently very undervalued, and you might have just jumped into investing in it right away without knowing that you have fell into a trap of poor fundamentals. Alright, so I would just like to use this chance to stress the importance of fundamentals over valuation. And in fact, if a company is not fundamentally strong, there's no need to go through step 6 and to even look at the dividend yield at all, because it wouldn't make much sense. Nonetheless, I'll still present the result for you to make things complete. It has a dividend yield of 3.9% with an exceptionally low payout ratio, but has been increasing generally over the years. Let us take a look at its stock chart. This is the monthly chart for Citigroup, currently trading at $51.20. And from its chart, things does not look good and pretty at all. Look at its pre-global financial crisis high. It has a high of about $560. And look at where it is right now. So it is still 90% below its pre-global financial crisis high. And this is likely what is going to happen if you invest in fundamentally weak companies. Once something bad happens and they fell off from their all-time high, they might never have the chance again to climb back to where they were. And for our last bank of the day, we have Wells Fargo. For Wells Fargo, net interest income, I can still see it as increasing consistently for the past 5 years, but not for net income and not for cash from operating activities. Growth rate wise, it is still on the low end. Competitive advantage, even worse than Citigroup. Net profit margin of only 7.63%, the lowest of all the banks that we have seen today. And ROE is also the lowest of all the banks that we have analyzed today, at only 2.4%. On the other hand, debt to equity ratio is the highest amongst all the banks that we have seen today. Once again, another company with weak fundamentals that has not passed any of our criteria. What about its valuation? So not surprisingly, it is currently undervalued with a price to book of only 0.64. Dividend yield is also the lowest amongst all at only 1.62%. And the payout ratio is slightly high, nearing 40% over the years. And as of 2020, its payout ratio have shot up all the way to almost 230%. As for the stock chart of Wells Fargo, surprisingly for a company that has not passed most of our steps, its stock chart, I must say, is one of the most beautiful of the four banks that we have seen today. Even nicer than JP Morgan itself. Ever since its history, stock prices for Wells Fargo has been increasing all the way consistently till today, with short consolidation period in between. However, the recent situation might not be as pretty. While for the other three banks, we can see that they have already started recovering from their March lows. For Wells Fargo, it is still consistently dropping lower and lower month after month. So this might be something that you might want to pay attention to if you are holding a position in the bank itself. Out of the four largest US banks, looks like only JP Morgan and Bank of America are the better ones that meets the requirements of increasing profitability and having competitive advantage. While Citigroup and Wells Fargo are the most undervalued US banks that we have looked at today, they are undervalued for a reason, and that is because of their terrible fundamentals. Once again, I hope you realize the importance of fundamental strength over valuation. Growth and yield-wise is generally low across the US banks. But does that mean that the US banks are not worthwhile of your investments? Actually, no. If you do a comparison across the banks from different regions, this is how the US banks fare against the Singapore and the Chinese banks. Growth and yield-wise, US is the lowest, not surprising. Singapore banks have the highest growth, averaging about 10%, while having a similar rate of dividend yield compared to the Chinese banks, lagging behind by about 1%. Valuation-wise, Chinese banks are the most undervalued, with a price to book of approximately 0.5. And this is followed by Singapore and the US banks, accounting only for the fundamentally strong banks in the US. And to make matters worse, dividends from US companies are subjected to a 30% withholding tax for foreigners like myself. As a local, my dividends from Singapore banks are tax-free. And at this point, I would like to point out that dividends from Chinese banks will be subjected to a 10% withholding tax as well if you are a foreign investor. In my analysis video for the Chinese banks, I have incorrectly stated that there are no withholding tax from the Chinese banks to foreign investors. So please take note of that correction. So far, the US banks have been getting the short end of the sticks for all the criteria. But investing in the US banks does have its merit, and that comes from the availability of options. With options, I'm able to sell cash secured puts and covered calls on stocks that I own, in what is known as a wheel strategy. This helps to boost my investment returns by a potential 24% yearly. In fact, options are so powerful that despite the low growth and yield, my investment returns from the US side is able to match that of my Singapore banks. Although Chinese banks in the Hong Kong exchange does have options available as well, the last I checked, the premium is quite low. So I'm still thinking of ways to effectively invest in the Chinese banking sector. To me, both US and Singapore are equally good. And of course, investments for each of these regions will require a different mindset and style. After doing 3 series of bank analysis for you guys, what have we learned? Of course, the analysis strategy that I use for these videos aren't perfect. For instance, we saw that none of the banks are capable of meeting the requirement of a consistently increasing operating cash flow for 5 years. This is due to the nature of their business that led to them having inconsistent cash flow. We also saw that all the banks have a ridiculously high debt to equity ratio. Therefore, more in-depth metrics will be necessary to better evaluate the banking industry. If you are interested, you can consider things like the Basel III model, which looks at aspects of capital requirements, leverage ratio, and liquidity requirements, or the commonly used CET1 ratio. Nonetheless, let me know what you think of these banks. Which ones are your favorite? And if you will be getting into any of them. Type them into the comments below or join our Growing Wealth community group to share your ideas. This is a group that promotes active sharing of investing and trading ideas. Do also like, share, and subscribe. Thank you so much for watching. I'll see you in the next video.